What's up, everyone? It's Scotty with MoneyVest. So in this video, I wanted to talk about the bond market, and we all know and are aware of that chart that pretty much suggested that the hedge funds have taken on a net short position on the U.S. Treasuries. They've been building it for months and now are doubling down even further to an extent where it's now eclipsed, I think, a little bit over $600 billion worth over 5 million contracts on U.S. Treasuries. So in this video, I wanted to break down what the end game might end up looking like, right? And why? And I was thinking about this today. I was like trying to really critically think on what the end game might look like and how this is very, very different from what we have previously seen. And I'll break down some of the stats for that as well. So as always, if you enjoyed this video and of course find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, get access to all the members-only private videos, trading view charts, buy and sell alerts. Everything is going to be included with the link down below. We'd love to have you on board. I did open up a few more spots if you're interested in joining and, of course, getting access to everything. So first things first, let's talk a little bit about this chart right here. And this right here is the chart that everyone's been talking about, right? So it's been a ongoing position. Bill Ackman's been very vocal in his idea that he is expecting the 30-year treasuries to go even higher and for treasury yields to continue to move up. And as a result, hedge funds continue adding to their short U.S. Treasury futures position, which has now reached the largest short position in history. Now, if this is the largest short position in history, that could also lead to potentially a largest short squeeze in history because, it's a pretty substantial number when you think about it with respect to, short end of the curve, long end of the curve. And we're looking at, several hundreds of billions of dollars worth of short positions. Now, this right here is basically, again, the futures contract yearly net positions in U.S. Treasuries. And you'll notice in 2023, we're looking at almost 4 million contracts. In 2022 was a little bit over 2.5 million contracts. So last couple of years, it's been kind of building up as yields have continued to go up and treasuries have continued to go down, and yields basically have continued to go down. And as a result, this is again TLT. This is the chart from Northman Trader, and we have done some extensive analysis on treasuries, TLT and TMF as well. And as you guys know, that we are, or me personally, I'm building a position in TMF as well, which is going to be a bit of a contrarian trade considering that everyone's short at the moment, especially when you look at the hedge funds. Now, the reason that I'm going to go over is actually quite against a potential short squeeze, and the reason for that is simple supply and demand. You see, when any trader takes a short position on a stock, right, what is one thing that is fixed in that short position? The supply, right? The supply is fixed, right? The person can only short to an extent of the floated shares outstanding, meaning whatever the supply of that share count is, right? So let's take Tesla, for example. If Tesla had 100 shares out there available to be traded in the open market, right? That's their floating shares outstanding. And somebody goes out there and shorts 50 of those 100 shares, the open short interest is 50%. Because that trader is shorting 50% of all Tesla shares available. And then, well, guess what? Eventually, when they're going to be buying back those shares, they're going to be buying back from that limited supply that's available of 100 shares. And that's what creates these sort of events and these circumstances for a squeeze. Why? Because they're squeezing out of that limited supply, right? And as a result, they're buying and they're covering back. And so prices go back up. In this example, though, if you look at the supply, it's not fixed. It's not limited, right? The treasury market it's the biggest market in the world. It's actually bigger than the equity market. It's actually 3 times bigger than the stock market. And to make matters worse, we know what's going on from a fiscal policy standpoint. We're constantly seeing new issuances and new supply hitting the market, not just corporate bonds, but government bonds. I mean, we're seeing $300, $400, $500 billion worth of bonds being issued in the market. So for that reason, given how large the market is with respect to treasuries and bonds, it's not like we're dealing with one stock with limited supply that can lead to a huge squeeze. We're dealing with the biggest market, treasury market, with the bonds in the trillions of dollars, and new supplies constantly hitting the market. And we're kind of witnessing the largest short, but at the same time, supply is increasing. It's not like the supply is limited. And for that reason, and again, correct me if I'm wrong, but for that reason, I do believe there is a less likelihood of a potential squeeze event. But that still doesn't take away from the fact that this is a larger short position, given anything what we have seen historically. So if you take a look at this is a good chart which basically goes over, and I'm not sure exactly how old this chart is, but I think it'll still give us somewhat of a decent understanding on what we're dealing with here. So if you take a look at the global bond market is more than twice as large as the global stock market. I think this is a little bit of an older chart. I think a newer chart will represent, I think it's bigger than 3 times is what I've learned that the bond market is versus equities market. So this is really where these shorts are coming from, right? 600 billion, 700 billion is still a very, very short amount of short interest compared to the entire market. Now, 88 trillion is 90 trillion, right? So that's what we're working with. If you do the math, 0.6 divided by 90, we're looking at, less than 1% short interest versus as individual stocks, what we've seen, that short interests have gone up to 40, 50, 80%, even beyond 100% through a lot of market manipulation. But for that reason, I think there's the probability for us to see a squeeze in TLT and TMF is low. But that being said, that doesn't take away from the fact that yields is where the focus needs to be, right? Our focus is not on the potential squeeze. That could be like the icing on cake if that actually ends up happening, but the focus is very much on the yields themselves and what's going to take place with the treasuries, right? Are we going to see the yields drop? I mean, this week we've seen the treasuries 10-year more specifically down over 4.79%. The 30-year is down over 5%. And the 20-year, which is what TLT basically tracks, down over 5%. So, week after week, we've seen this consistent move in the yields to the upside. And a lot of that is coming on the back of stronger economic growth, inflation expectations, the short end of the curve, very much dictated by what the Federal Reserve ends up doing. So if and when we start to see signs of a potential recession, or if there is deflation risk, or if there's a crisis, there's political pressure, or if there is any type of message from the Federal Reserve that rate cuts are coming, that's the bull thesis. That's the bull case for yields dropping and TLT moving higher. This week it's up 4%, right? It's obviously coming off of its 52-week lows, and TMF this week is up over 12%, so almost 13% this week alone, as we have continued to trade with these lower highs and lower lows. So the bottom line is, we've got a big sort of short position on our hands, but that doesn't necessarily mean that's going to lead to a squeeze, because given how large the entire market is, with respect to an individual stock. So it's that's why it's very difficult to squeeze, for investors to look at the short interest in a very large market versus an individual stock, right? Individual stocks, they're dealing with fixed limited supply, but with the bond market, it's so big. I mean, we're talking, trillions of dollars in the open market, and of course, the share counts are very, very high. Or the issuance is very, very high. So for that reason, I think the reasoning, the analysis, and the thesis very much needs to be on the yields and where the yields are going. Now, in my opinion, as I've already stated before, if there is any signs of weakness in the U.S. economy, if there's any signs of the labor market starting to crack and show signs of weakness, that's going to be the first telltale sign that the Federal Reserve is going to be more motivated to potentially cutting rates, and that can start pushing the short end of the curve lower, and we'll start to see the yields, kind of the yield spreads or the yield curve basically uninvert, and that's going to be the first signals for when the yields will start potentially coming down, and that's when the bond price ETFs can also start making a move higher. But this week so far has been very positive for bond price ETFs. Yields are lower, but it's only a matter of time for us to continue to monitor how this all plays out. Tomorrow, inflation numbers are going to play a bigger role as well. And then eventually, of course, what the Federal Reserve ends up doing at the end of this month. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. As always, make sure you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. Happy investing. I'll see you all in the next video.